All right, welcome back to Module 5 in our investment rental property course. I'm excited to dive into funding your rental properties in this module. Now, we've been talking a lot about the Deal Spotter system. We've made it through lead generation and that first filter of seller desire. Are the sellers even interested in selling you their property at this time? The ones that make it through and say, yes, we do a quick analysis on, we run quick numbers on it to see if it's going to be worth your time to pursue as an investment rental property. Now, the second filter is mortgage check. At this point, the ones that pencil out and actually become potential deals from a number perspective, we need to have a conversation with that homeowner. What do they owe on their mortgage? Are they even going to be able to entertain the number that we throw at them as our offer? If they give you a verbal yes at this point, we move on to step 3, which is the offer. Now, I recommend that you use your state's REPC, that's REPC, which stands for Real Estate Purchase Contract. Every state has a standard real estate purchase contract that they have created that basically they've said this is the legal way, this is the approved way to transact real estate in our state. So you're going to use that form. You can find it on Google or Bing or any of the search engines that you use for your particular state. You're going to use that form to submit your offer. Now, I want to talk about something because that's a pretty straightforward process. I want to talk about what you need to be doing between step 2 and step 3, and that is getting the funding in place for your properties. If they've made it through filter number 2, you need to start focusing on funding at this point in the game. So let's talk about the funding basics. You've got a couple of different ways that you can fund your investment rental properties. One of the most famous ways is the traditional form of financing, which is your FHA loan, your conventional loans, your mortgages. You've got farm and rural loans that you have access to. You've got VA loans, which is your Veterans Association loans that you have access to if you're a military veteran. You've got your non-traditional ways, other people's money, or OPM as we call it in the industry. You've got your private loans, your lines of credit, and your self-directed retirement plans, all of which we are going to be talking about throughout this module. So let's dive in and talk about traditional financing. The most common way people think about buying real estate is using a mortgage. Now, this isn't necessarily my favorite way. It just happens to be the most popular way. Remember that the costs and rules of mortgages are set by the banks and by the laws from the government. Private mortgage insurance is something that you always need to be aware of. If you're getting traditional financing, are you going to have PMI? Usually that's either paid up front, which would mean you have to add it to your initial investment, or it's paid monthly, which means it's going to be part of your debt service. Oftentimes with traditional financing and mortgages, there's low down payment options available. So you might want to entertain that to keep your initial investment number low. You also have variable rate ARMs or adjustable rate mortgages. The rates for adjustable rate mortgages are usually regulated by the banks and by state laws, and generally have caps on how high those interest rates can go. A lot of times those variable rate mortgages are interest only, or as we call it, IO. You probably want to avoid adjustable rate mortgages for the sake of investment rental properties because it creates an uncertainty as to what your debt service is going to be on an ongoing basis. Let's talk about some of the non-traditional financing ways, which is my favorite way to invest in real estate. I love using other people's money because it allows me to grow my investment portfolio further than my own personal resources would allow. This means going out and finding private investors or partners to partner up with me on these rental properties. A lot of times these are people with money but no time. Might be someone like your dentist or someone who makes a lot of money at their job but has no time to learn how to go out and invest in rental properties. Most people with money know that real estate investing is a great investment option and are ready and willing to partner up with you if you can show them that the numbers work. Another way to use other people's money is by doing a strategy called sandwich leases. This is where instead of purchasing a property, you go lease the property. Let the owner of the property continue to make their payments. You lease the property for a low amount of money, turn around, put it on the market, and lease it to the person who's going to live in the house. And you make the difference in that sandwich lease. Private loans are a great way to come up with the money to be able to go out and purchase rental real estate. This may include hard money, but be careful because a lot of these hard money lenders also come with high interest rates. They're also a very short-term solution, so you're gonna have to get creative. If you purchase the property with hard money, be prepared to refinance it out in the short term into possibly a long-term mortgage or a line of credit. which leads us right into lines of credit. This is one of my favorite ways to go about buying rental properties. You can use the equity from existing properties like your personal residence or an investment portfolio to go out and buy more rentals. This is done through lending instruments such as HELOCs, where you can tap into the equity of your property by getting a line of credit collateralized by that equity, and then using that money to go out and buy another deal. The great thing about lines of credit is they're usually easier to get than mortgages. A lot of times they only require what's called a desk appraisal, which means you're not paying for an appraiser to go out and assess the value of your property in person. Lines of credit, like HELOCs, oftentimes have no closing costs and very low costs associated with the loans. They do tend to, however, have a little higher interest rate, so it is something that you're gonna have to be aware of as you're running your numbers. One of the country's untapped resources when it comes to real estate investing is self-directed retirement accounts. This is how I started my career. One of the first strategies that I learned was how to use other people's self-directed 401ks or IRAs to go out and partner on real estate. You can do this with fix and flips, and more importantly, you can do this with investment rental properties. Now, there are very specific rules governed by the IRS and the federal government on how you can use these funds. Remember that these rules change frequently, so you want to make sure that you're aware of what those rules are, and that can usually be done by consulting with the custodian. Now, any self-directed retirement account requires a custodian, which is usually a third-party attorney that simply oversees the investment strategies of that self-directed account and keeps you out of trouble. He's gonna make sure that you're not getting into some sort of Ponzi scheme, that your collateral's there, and that your retirement account funds are protected in that asset. Remember that if you're partnering with someone who is using their self-directed retirement account, that person cannot benefit directly from the profits of the property. You're not partnering with the owner of the retirement account, you're partnering with the retirement account itself. So as cash flow is paid out on a monthly basis, you get to take your cut, and then your partner's cut goes directly back into their retirement account as growth. Another fantastic way that I love to fund my rental properties is through partnerships. By putting a handful of people together who may have $10,000 or $20,000 to bring to the table, we can usually fund an entire rental property with just a handful of partners. Another fantastic way to fund your investment real estate is through a private placement memorandum, or a PPM. This is just a hair away from putting together an actual fund where investors come in and pool their money so that you can go buy real estate. This is particularly awesome when it comes to buying multifamily rental properties. Now, a few things to keep in mind. You do have a little bit more scrutiny from the SEC and other governing officials, so make sure that you do this one right. Other options include hedge funds, as well as other funds that are out there to help you invest in real estate. Now, that brings us to what, in my opinion, is the pinnacle of creative financing when it comes to investment rental real estate, and that is seller financing. This is where the seller is the bank, and it's a great strategy for buying or selling. This is where the previous owner either owns the property outright and is willing to let you pay over time for that property, or they keep their mortgage in place and are willing to let you assume the payments of that mortgage. Now, to be clear, they keep the mortgage in their name, but move the title to your name. This is all done contractually and through a title company. Now, if we're talking about the option where they leave their mortgage in place and turn the title over to you, that strategy is called subject to. I have funded over 90% of my real estate portfolio using the subject to strategy, and in my opinion, it's the best way to do it. So let's dive in and talk about this one in greater detail. Now, subject to creates a win-win for you and the seller. We do that by helping people prevent derogatory marks on their credit. Where we find people that are willing to leave their mortgage in place and let you take over the deed is usually people who are about to lose their homes to the bank. We present a better option for them. We come in and say, hey, look, the bank's about to take your property. They're going to destroy your credit with a foreclosure mark that's going to be on there for 7 to 10 years. I have a better option for you. Why don't you let me take the house? I'm going to catch you up on your missed payments, which is going to prevent that foreclosure from going through. And then on an ongoing basis, I will continue to make payments on your mortgage, which will take that derogatory mark of a late mortgage, make it current, and show continual performance, which will improve your credit, so that you can enjoy home ownership within 2 to 3 years versus the 7 to 10 years that you'd have to wait if that foreclosure went through. This is an ideal strategy for someone who is about to lose their house. You come in and save their credit from getting a 10-year ding while picking up an investment property. There's no better way to create a win-win. Usually there's a 5-year balloon associated with a subject to property, which means that you're either going to refinance or pay off the loan or sell the property within that 5-year period. However, there is no legal limit to the term that you can have on a subject to deal. It could be 30 years, it could be 100 years, whatever you're able to negotiate with the seller. So let's dive a little bit deeper into this subject to process. Subject to is short for purchase subject to the existing financing staying in place. We shorten that to subject to, it's much easier to say. You may have heard other terms used for it, like a wraparound mortgage or a sandwich loan. Subject to is my favorite acquisition strategy for long-term rentals because it transfers ownership to me while leaving the seller's mortgage in place, in their name and on their credit. Now, this is a little bit more complex of a strategy, so you always want to involve your attorney in these transactions, as there are many, many moving parts. I've been doing this for about 10 years now, and I still involve my attorney on every subject to transaction that I do. Now, I have a few pointers for you as you go into the negotiation with the seller. You want to avoid using terminology that the property owner won't understand. Remember that you're dealing with people who aren't as educated as you when it comes to real estate investing. And terms like creative financing or subject to might intimidate them enough to just say, you know what, never mind, go away, right? So we don't want to use those types of terms. So instead, ask them if they'd like you to take over their payments and then explain how it works. If they're a distressed seller, don't open by talking about their problem. You don't want to start by saying, hey, I know you're going through bankruptcy, or I know that the bank is foreclosing on you. That starts out the conversation on a negative foot. Instead, open with something benign. I'm looking to purchase a home in your neighborhood, and you're stuck out to me. Would you be open to accepting an offer? Something positive like that will start the relationship off on the right foot, and then you can get into the details of taking over the payments on their mortgage and bailing them out of their bad situation. So as we're diving into subject to, it's important to remember that you're gonna have to bring some money to the table to bring their mortgage current. Usually we're dealing with people who are in some sort of distress, like foreclosure, because they got behind on their payments. If we're going to continue to use their mortgage, we need to bring that mortgage back into good standing so that we can continue to use it in the long term. That means whatever that amount of money that we're bringing to the table to bring that mortgage current, we need to add to our initial investment category in our quick analysis. You may not have the money readily available that you need to catch that person up. So this is where we talk about going out and finding a partner to work with. Maybe it's a professional that you know that makes a lot of money and wants to partner with you on some real estate. Maybe it's someone's self-directed retirement account. Tap into your existing network. You want to talk about real estate investing in casual conversation just so that people know that you're doing it. You'll be amazed at how many people come out of the woodwork and express interest in investing in real estate alongside you. Attend investment clubs, attend your local networking groups, and maximize awareness of your real estate investing activities. Now, just a quick word of caution behind this. It's illegal to solicit funds publicly unless you have a securities license. So while you're out talking about real estate investing, you want to be mostly focused on what you're doing in real estate in general. You never want to say in a group of people, I'm raising money for a rental property, come throw your money at me. That's actually a securities violation. So there's a gray line to walk there. Just make sure you're on the safe side of it. Once you've got all the money in place, it's time to transact the property. Now, to do this, you want to go through a title professional. In some states, that's a title company. In others, it's a real estate attorney. Based on which state you live in, make sure that you're using a real estate professional that has dealt with seller financing before to make this process an easy one for you. Subject to is a form of seller financing, and when you take title on a seller finance transaction, it's important to know how that title is transferred. Here are some of the most common ways. The most common way is an all-inclusive trust deed, or abbreviated as AITD. This transfers the title and the rights of the property to you immediately. It's used for properties with underlying mortgages. The second way is a note and a deed of trust. This transfers the title and rights of the property to you immediately with a note or a loan payable to the seller. This is primarily used for properties that are owned free and clear by the seller. The third way is contract for deed. This transfers the title and the rights to the property to you when the note or the loan is paid off in full. So when we talk about purchasing properties using seller financing, an all-inclusive trust deed is what you're going to use if the seller has a mortgage in place that's going to stay in place when the deed is transferred. A note and deed of trust is what you will use if the seller owns the property free and clear. And contract for deed is best when we're selling a property. Now, contract for deed, I don't like to use when buying a property because I don't hold the title, which means I have less control, which is not ideal for me as an investor. But if I were to sell a property on seller financing, I like to use contract for deed because then the title stays with me as the seller until that loan is paid for in full. It gives me more control, it gives me more security. So hopefully that gives you a good idea on how to use those tools. For subject to transactions, I prefer the all-inclusive trust deed for purchasing and the contract for deed when selling. There are a few tools you'll need as you're going through the subject to process. You'll need the REPC. That's the state-approved real estate purchase contract that we talked about earlier. You can find that on your favorite search engine by typing in REPC and the name of your state. You'll also need the seller finance addendum. Most states have approved addendums that go along with that real estate purchase contract. And in this case, you're going to need the seller finance addendum. Again, that usually can be found by using your trusty search engine. You're going to need a seller finance and amortization calculator. I prefer the HB 10B2 finance calculator. And you'll need a relationship with a title company that has experience with seller finance transactions. Now, here are some of the pros and cons to weigh as you're deciding whether or not subject to is the right way to approach funding a rental property. Some of the pros: the mortgage isn't in your name or on your credit, which lowers your risk as the investor. There's not really any application process as the bank and the underwriter and the loan officer are all the seller. So you negotiate directly with the seller in this case. And if it's structured right, you're helping people. There's an old saying that a mentor taught me. There's no good deal in real estate investing unless it's a good deal for everyone involved. That includes you, the seller, and whoever's money is coming to the table. Make sure that you're doing good business with integrity and you'll last a really long time in this business. Now, some of the cons of subject to. You have a risk of the bank calling the note due even though you brought that mortgage current. Now, I think people tend to worry about this problem a little bit more than they need to. I have actually never seen a bank call a note due once we've caught it up. There's all sorts of verbiage in the mortgage contract that says that they can, but remember, a bank is in the business of receiving payments, not in the business of owning real estate. If they wanted to own real estate, they'd take their billions of dollars and they would go buy real estate, but they don't. Instead, their business model is they lend that money to you and receive payments in return. So if we're doing what we're supposed to be doing on these mortgages, and that is making those payments on time every single month, you shouldn't have a problem. Also, one of the cons to consider about subject to is that there's extra people involved. The seller in particular is a relationship that you will have to continue throughout the course of owning this property. Now, you weigh those two and you decide whether or not this is a good fit for you. Guys, this is the end of the funding rentals module. This has been module 5. Hopefully you learned a bunch of amazing stuff, and we will see you guys in module 6. Talk to you soon. Thanks for watching. If you enjoyed this content, please consider subscribing. If you want to learn even more about this topic, hop on a free one-on-one strategy call with us. All you have to do is visit flippin.education to book your call today. That's flippin.education. Hope to see you there. And until next time, we'll see you on the flip side.